Are we buying I-bonds this month? And should you redeem 0%, 0.4%, and 0.9% fixed rate I-bonds to pick up new ones with a higher fixed rate of 1.2%? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekend update. As worries about tariff inflation continue to grow, so do the questions about how to protect your money against this potential rise in prices. So, with that in mind, here are the three topics that we'll be covering in today's video. 1. I-bonds. Should you redeem 0%, 0.4%, and 0.9% fixed rate I-bonds to pick up new ones with a higher fixed rate of 1.2%? This is a question that we've received quite a lot over the past few days. So let's walk through what those break-even numbers look like. 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the yield expectations for the upcoming week's 2, 5, and 7-year treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Should you redeem 0%, 0.4%, and 0.9% fixed rate I-bonds to pick up new ones with a higher fixed rate of 1.2%? As we walk through in detail in this recent May I-bond rate projection video, link below in the first pinned comment for your convenience, here's where we currently stand on the I-bond rates. For all I-bonds issued in April, the fixed rate you will get is a guaranteed 1.2% for the entire 30-year term of the I-bond. The inflation rate, which changes every 6 months, is 1.9% for the first 6 months and 2.86% for the second 6 months. Remember that even though the inflation rate changes every 6 months, these are annualized numbers that you see here, as I-bond rates, like all fixed income rates, are quoted on an annualized basis. For all I-bonds that will be issued between May and October of this year, we are projecting a fixed rate of 1.1% for the entire 30-year term of the I-bond. The inflation rate is 2.86% for the first 6 months, and at the moment, unknown for the second 6 months. As our Diamond NestEgg regulars know, I-bonds serve a dual purpose for me and Marcus, as inflation-protected emergency savings, as well as inflation-protected retirement savings. So we're both actually going to buy our annual I-bond limit of $10,000 this month to grab this guaranteed 1.2% fixed rate, the second highest fixed rate in more than 15 years. Guaranteed is great in our minds, especially given the current uncertain and volatile market environment. And even though the inflation rate will be higher for the first 6 months, if we wait until May to pick up our I-bonds, we're long-term I-bond holders, so the fixed rate is what's most important to us in any case. We will be using new money to make this I-bond purchase, as we no longer hold I-bonds with a fixed rate lower than the current 1.2%. But for those of you who do hold 0%, 0.4%, or 0.9% fixed rate I-bonds, and who are considering redeeming those I-bonds to purchase new ones in April, let's take a look at our 3 break-even scenarios if you want to redeem your old I-bonds and reinvest in new ones. Namely, if you decide to redeem your old I-bonds with a fixed rate of 0%, 0.4%, or 0.9% to purchase new I-bonds at the current fixed rate of 1.2%. Section 1 here shows the numbers for your current I-bond holdings under 3 different scenarios. In this row, we have the old I-bond fixed rates of 0%, 0.4%, and 0.9%. In this row, we have the current semi-annual inflation rate of 0.95% times 2, giving us a 1.9% annualized inflation rate for all 3 scenarios. And here is the bump, which is basically the fixed rate multiplied by the semi-annual inflation rate. And here we have the total combined I-bond rate, which is equal to the fixed rate plus the semi-annual inflation rate times 2 plus the bump. And here's the total combined I-bond rate for all 3 scenarios. Bond beginners, folks, please refer back to Module 7 on I-bonds if you need a detailed refresher on how to calculate the total combined I-bond rate. Moving on now to Section 2 in the middle here. This section shows the fixed rate for the new I-bonds that you might be purchasing before the end of April 2025. And because we're talking about redeeming your old I bonds and using the proceeds to buy new I bonds, we can ignore the inflation rate for scenarios going forward here. Because whether you keep your old I bonds or swap them for new I bonds, you will get the inflation rate in both cases. And the inflation rate is not a factor that should influence your decision. So here's the current I bond fixed rate of 1.2%. That's valid for all I bonds issued from now until April 30th, 2025. And it will be the same under all scenarios, of course, because that will be the new I bonds you would be buying. And this row shows the amount that we're redeeming and reinvesting in this example. Let's assume that we're redeeming and reinvesting $1,000 for this break-even analysis. Now, let's move on to section 3 here on the bottom, showing the break-even calculation. And let's start with these 0% fixed rate I bonds first before we move on to the 0.4% and 0.9% fixed rate I bonds. Here is the early withdrawal penalty on the redemption as a percentage. That's this total combined annualized I bond rate here divided by 4, because the early withdrawal penalty is always the last 3 months total combined I bond interest if you redeem after the first year, but before the end of year 5 of your I bond. Multiply this by this $1,000 that we're redeeming and reinvesting here. And here's the early withdrawal penalty amount in dollars that we lose per $1,000 if we redeem early. Basically, what we lose with the redemption reinvestment process. And here is what we gain. Here's the extra fixed rate, the additional fixed rate that we earn in percentage terms on an annualized basis. That's this current I bond fixed rate that we get per year if we decide to buy new I bonds, minus the old I bond fixed rate here that we would have gotten anyway had we not redeemed. So by redeeming these 0% fixed rate I bonds here and reinvesting those redemption proceeds into 1.2% fixed rate I bonds here, we earn 1.2% more per year than if we just kept our old I bonds. We will also earn the inflation rate on top, of course, but as we discussed before, you will get the inflation rate in either case, both if you keep the old I bonds and if you swap into new I bonds. So we can ignore the inflation rate for the reinvestment benefit calculation. Multiply this by this $1,000 that we're redeeming and reinvesting here. And here's the extra fixed rate amount in dollars, the additional dollars that we earn per year on a $1,000 investment if we redeem and reinvest. And to get to the break even, we would divide the early withdrawal penalty in dollars that we lose by the extra fixed rate amount, the additional fixed rate dollars that we earn or gain. And because these are all annualized numbers, we then multiply by 12 to get to the number of months needed to break even. About 5 months essentially for 0% fixed rate I bonds. Meaning that it will take you about 5 months to earn back the early withdrawal penalty if you redeem and reinvest your old 0% fixed rate I bonds before the end of year 5 of your investment. Or in other words, it makes sense to redeem and reinvest your old I bonds with a 0% fixed rate if you're planning on holding them for more than 5 months, because you will start earning an extra return on your investment after these 5 months. And remember, there is a minimum holding period of 12 months for all newly purchased I bonds, meaning you can't redeem them until then anyway. Now, let's run the same analysis for 0.4% fixed rate I bonds. And here's what the numbers look like, resulting in a break-even time of about 9 months. And if we run the same analysis for the 0.9% fixed rate I bonds, here's what the numbers look like, with a break-even time of about 28 months, or nearly 2.5 years. If we look at all of our 3 scenarios, what we can see is 2 things. First, redeeming and reinvesting your I bonds under these scenarios only makes sense if you plan on holding your I bonds longer term, and specifically beyond the time required to break even. And second, the higher the fixed rate is on your old I bonds, the longer it will take for you to break even, as we can see here. The higher the old fixed rate, the smaller the uptick from reinvesting in the newer I bonds, and the longer the break even in months. So, these break-even scenarios that we just walked through, there are a few assumptions and considerations to keep in mind. First, our break-even analysis assumes a reinvestment scenario versus the baseline scenario of staying invested in I-bonds, meaning that even if you do nothing, you will keep earning the old fixed rate plus the inflation rate going forward. Second, our break-even analysis assumes an early withdrawal penalty of the last 3 months' interest, which is applicable to I-bonds held more than 1 year, but less than 5 years. But if you've been holding your I-bonds for more than 5 years already, there is no early withdrawal penalty, and you basically have an immediate break-even and can switch regardless of how long you intend to hold the I-bonds. And if you've been holding your I-bonds for less than 1 year, well, then you simply can't redeem them in the vast majority of cases. So it's a moot point whether you should redeem and reinvest. Third, remember that the maximum annual purchase limit for I-bonds is $10,000 per Social Security number under normal circumstances. So if your redemption proceeds are more than $10,000, you will need to take that into consideration in your personal calculations. But do remember that you don't have to redeem all your old I-bonds in one go. For example, let's say your old I-bonds have grown to $11,000 over the past few years with accrued interest, but your limit for new I-bond purchases in this year is only $10,000. Then you can simply redeem and reinvest $10,000 of your old I-bonds and let the remaining $1,000 continue to earn the inflation rate plus any old fixed rate that they may have, which provides a perfect transition to one final point. Remember that I-bond redemptions always consist of principal and the prorated interest amount, and in the year of redemption, taxes may come due as part of that interest. You cannot choose to withdraw only principal or only accrued interest. It'll always be a prorated mix of the two. For purposes of our scenarios, we assume that the redeemed amount for reinvestment is the net amount after tax. Now that you know what the break-even numbers look like, will you be redeeming your lower fixed rate I-bonds to buy new ones at the current fixed rate of 1.2%? Or are you buying more I-bonds with new money? Or are you going to wait until after April when the new fixed rate will be announced? Drop a comment below and let me and the community know. And let's move on now to the next section of today's video. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's daily Treasury par yield curve rates page and compare Treasury yields from this past Thursday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Thursday. The bond market was closed on Good Friday. And here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black and decreases in rates are shown in red. The 6-month was up, but only slightly by 1 basis point. The 1.5-month, 2-month, 3-month, and 4-month were unchanged. Treasury yields across all other maturities were down, which is even to be somewhat expected given how much they had spiked the week before last. The 5-year and the 7-year were down the most at minus 20 and minus 19 basis points, respectively. And all maturities between 1 year and 5 year are still below 4%. Now, let's take a look at Treasury yields from this past Thursday versus the beginning of the year. This row shows where rates ended this past Thursday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The 2-month, 4-month, and the 30-year treasuries are only up very slightly since the beginning of the year, with the 2-month up by 2 basis points, the 4-month up by 4 basis points, and the 30-year up by just a tiny 1 basis point. Let's see if they're able to hang onto these increases in the coming weeks. Treasuries across all other maturities are now lower than where they were on January 2nd. Down the most are the 2-year at minus 44 basis points, the 3-year at minus 47 basis points, and the 5-year at minus 43 basis points. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum, the yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the yield expectations for the upcoming week's 2, 5, and 7-year Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. The 2-year T-note, the 5-year T-note, and the 7-year T-note will be auctioned off as well this coming week. None of these are reopening auctions, so the coupon remains to be determined. There's also a 2-year floating rate note auction happening this coming week. At the time of this taping on Fidelity's platform, here's what the coupon and the expected yield are for the 2-year T-note auction. And here's what the coupon and the expected yield are for the 5-year T-note auction. And here's what the coupon and the expected yield are for the 7-year T-note auction. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs, the highest yielding new issue agency bonds on Fidelity at the moment are paying 5.9%. Do note the different issuers and maturity dates though. This one here is from Federal Farm Credit Banks with a first call date in July 2025. The QSIP is 313-3ET-EB9 for those of you who may be interested. This one here is also from Federal Farm Credit Banks with a first call date in April 2026. The QSIP is 313-3ET-DS3 for those of you who may be interested. And this one here is from Federal Home Loan Banks with a first call date in April 2026 as well. The QSIP is 3130B5YQ5 for those of you who may be interested. For corporate bonds, there's only one new issue on Fidelity's platform at the moment from Bank of America at 4.8% with a first call date in October 2025. Not super attractive in my mind, but just in case, the QSIP is 06055JLD9 for those of you who may be interested. For brokered CDs, the highest yielding ones are paying 4.35% right now. This one from US Bank has a first call date in October 2025. This one from First State Bank has a first call date in November 2025. And this one from Jonesboro State Bank has a first call date in July 2025. As always, if you know of any bank CDs or checking and savings accounts with particularly attractive rates at the moment, then please do drop them below and let me and the community know. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about bond investing and building a bond portfolio, then check out this video here on our bond courses. And come join our next live member Q&A today, Saturday, April 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into the 2, 5, and 7-year T-note auctions and all things fixed income. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.